Morning, everyone. Welcome back to our morning cuppa at 8. I'm Joseph here. First of all, let's take a look at the Hang Seng Index. The index did a second day of rebound yesterday, but looking at the price pattern, there is a long upper shadow, and right now the 20 days moving average will remain as resistance. Hence, rebound is not strong, and the resistance remains unchanged at 26,000 point. So we'll keep our bearish bias on the Hang Seng Index until it climbs above 26,000 point. Looking at the market breadth yesterday, right, can see that from the heat map, right, the top three big caps in the Hong Kong market, 9988, Alibaba, 710 cents, right, they close in the negative territory. Now, only the Zhongxin Guoji 981 managed to stage a rebound by 7% yesterday, right? So the sentiment was rather mixed in the Hong Kong market yesterday, but pictures are very different in the China market. So you look at the A50, we track the largest 50 stocks that list in the Chinese market. You can see that it has a very long bullish candlestick yesterday. And looking at the heat map on all the Chinese companies in the China market, right, most are recorded in the green positive territory. Only small handful of stocks that recorded in the negative territory. Hence, comparing with the Hong Kong as well as the China market, seems like China market are more responsive and more easier to make money right now. Right. So this morning I'll look at one Chinese stocks, which is the China A shares listed in the Shenzhen 000630, right, which is the Chinese name called Tong Ling You Se. Yes, a break past 7 renminbi 40 cents. Next R1 will be 820 and followed by 9 renminbi. Down support is 6 renminbi 60 cents. Right. If you look at yesterday Chinese market, be it the Hang Seng, be it the Shanghai or the Shenzhen, right? The Shanghai start with the number 6, and Shenzhen is number 3, and also start with the 0, right? These are, you can see that this both exchange most of the stocks that are in the positive territory. So instead of just looking at the Hong Kong market, right, you can actually consider to add one or two China stocks. You can actually contact our dealer or advisor on how to have exposure in the China A shares. So then on today, market will go back to the macro news, which Japan and Europe is going to have their monetary policy today, especially the Japan Central Bank. And what happened tomorrow, Wednesday, is US is going to have their Fed meeting, that first time chaired by the newly installed chairman, Walsh. But at this juncture, sentiment is that all voice vote for no rate cut at 375. However, coming to the year end, right, about 42% thinks that there will be no rate cut. However, there are 41% think that there will be one rate hike due to the heightened inflation. But I think Monday, all right, the sentiment have changed tremendously because Trump have posted he had managed to strike a deal with Iran, and so all I will be looking at what happened on this coming Friday. Is the Straits of Hormuz going to fully reopen? Based on the oil news that we have understand yesterday, right? Some of the LNG tankers start to leaving the Strait of Hormuz, and some of the LNG tankers are heading towards the Gulf of this Hormuz Straits to reload the oil. Looks like the traffics are getting busier, and not to forget, last week the energy minister from the US also mentions that there are a few ships start to actually leave the Hormuz Straits based on a dark mode, right? They turn off their sensor so that not detected by anyone, that they manage to sneak out from the Hormuz Straits. And that's why you can see that oil price have been coming down for at least the past 2 weeks, even though the US helicopter being struck down by missile, right? It just cannot lift up the oil price. Yeah. Hence, I think that if the oil price continue to actually move downwards, hopefully it will relieve the pressure on the rate hike. So oil have breached the 85 support level. Right now, trading barely above the 80 level. Breach of 80, we'll see the oil retreats towards the 70 level. This juncture will keep a bearish bias on the US WTI. Meanwhile, we still have a bearish bias on the COMEX Gold, but we have revised downwards our stop loss point from 4,008 to become a 4,004. Bridge on the 4,004 should lift the COMEX Gold higher. What we notice right now is that the pressure on the bond yield have been coming downwards, and if that trend continues, likelihood COMEX Gold will see more room on the upside. So we have a bearish bias on the COMEX Gold until it break past 4,004 threshold. Now, meanwhile, on the US equity sentiment become a risk on after the SpaceX listed on the Friday, right? On the so the S&P 500 right now have reclimbed above 7,005, resuming the uptrend towards the 8,000 level. So I think that over here we have learned one important lesson is that the firstly the SpaceX IPO will actually pull back the market, but once the SpaceX IPO over, where the money going back to the market again, that's where the index is going to rally again. Second half of this year, there will be another IPO is going to happen in the US, which is the OpenAI and also the another AI company, right? So these two AI company, again, we're going to attract the funds from the market, and we shall see another pullback, another rally, another pullback, another rally again. So just do not forget that what we have experienced on last week, and remember that we are going to repeat the same strategy again in the second half of this year. So based on the US heat map right now, funds are going back to the big cap stocks. Micron, and AMD have actually have attracted a very strong flow. However, we can see that a few big cap names like Google, Microsoft, right? Markets worried that there will be some fundraising on 2026 and 2027. The shares are slightly sideways right now. However, mentioned about OpenAI, one of the largest investor, shareholder is Microsoft. Share price is hovering at a 400 level, breakup from 400, may open room towards 440. Downside support will be somewhere at 370 and 340. Okay. Then on the, I think the sentiment on the travel related counters have received a very strong flow yesterday. Airbnb have a strong rebound yesterday, testing the 140. So if breakout happened today, I'll climb towards 150 and 160. Downside support is at 130. So meanwhile, for FKLI, right now it's testing the resistance at 1,007. So if this bullish momentum follow through, it may climb above 1,720. So right now we set our stop loss point for the FKLI at 1,720. Climbing above the 1,720 level, also see the FKLI cross above the moving average of 50 days line. So at this juncture, we have a bearish bias until it climb above 1,720. In tandem with the weakness of the oil price, the FCPO also experienced another corrections yesterday. In fact, it has been coming down for the past 2 weeks after hitting the resistance at 4,007. So at this juncture, we'll keep a bearish bias on the FCPO unless it climb above 4,007. So on the downside, we think that FCPO potentially will retreat towards 4390 or even lower support at 4,003. Okay. As for the trading stock in Malaysia this morning, firstly we look at Asia, which break past 1 ringgit and 30 cents on the back of high volume. Next R1 will be 1 ringgit 45 and followed by 1 ringgit 55. Downside support is 1 ringgit 20. Secondly, we have a Golden Destinations Group, newly listed counters in Busan, Malaysia. You have a break past 38 cents on the back of high volume as well. So Golden Destinations, the GD Group is heading towards 41 and followed by 44 cents. Now support is marked at 36 cents. So we have Asia X and followed by Golden Destinations, both breakout stocks. I'll stop here and pass on to Jeffrey on the telco sector result wrap. Thank you.
Thanks very much, Joseph. Okay, we move on to the first quarter results wrap for the telcos. The usual report that we produce post results. If you look at the telcos, with the exception of OCK Group, which is really a small cap telco infrastructure player, the rest of the telcos on our coverage reported broadly in line results for the March quarter. Shorter working days and you have the high base effects in fourth quarter 25, i.e. roaming revenues as well as promotions, led to a sequentially weaker industry revenue. But if you look at sector EBITDA, it basically ticked up 5% Q on Q. That's coming really from stronger EBITDA growth at CelcomDigi. That's from lower provision of doubtful debts and lower OPEX, as well as TM's lower OPEX. 2% Q on Q drop in terms of industry mobile revenue was led by prepaid. Prepaid still under a little bit of pressure, 2.8% Q on Q down. Postpaid revenues were also down 1.5% on a sequential basis. Telcos reported blended ARPUs that were lower across the board. So both prepaid and postpaid saw lower ARPUs, obviously due to seasonality and of course that high base effect in the previous quarter. So in terms of revenue and EBITDA market share, Maxis and saw a slight increase there. Revenue market share was up 43.4% and 43.8% in terms of EBITDA market share. Just less than a percent increase, really. That's coming from that's really coming at the expense of CelcomDigi, which continues to face some pressure in terms of the commercial side of it. What's in store for second half of this year? In terms of guidance, I think the telcos have really retained their guidance for the whole year. It's still fairly early. Obviously, first quarter numbers, second quarter may change a little bit. But if you look at the guidance as a whole, I think most telcos, at least for the mobile network operators, they're looking at a flattish EBITDA growth. TM is also looking at flat EBIT. That's really coming from potential pressure there in terms of the cost side of things. A lot of questions in terms of the Middle East crisis and how that will affect the telcos. I think it's really a second or even third order impact, really manageable at this time in terms of cost pressures. Otherwise, the revenue side of things should be relatively more resilient. The pressure on consumption propensity, though, from a prolonged energy crisis, should see sustained competition in the second half. I do expect the value offerings that the telcos are delivering to be very much part of second half commercial execution as well. The unsettling global macro picture obviously will have an impact in terms of enterprise and IT digital investment sort of spending, which obviously is an emerging growth lever for most telcos. On the policy front, obviously the Jendela Phase 2 project awards, this should be announced sometime in September. This will benefit MNOs as well as the telco infrastructure players. People like OCK, Rich10, Redtone, tend to be capitalized by this sort of developments. Aside from that, if you look at the 5G side of things, no change there in terms of our view. I mean, it's still very cautious. TM obviously is terminating the access agreement with Digital Nasional Berhad. That is still up in the air. I think that discussions are still ongoing between MCMC, the regulator, as well as DNB. U Mobile obviously has upped the ante. They're the second access provider in terms of 5G network. They're actually meeting their COPA targets fairly well. And going to 2027, I think competition will be fairly tight coming from U Mobile's 5G access. So if you look at the policy side of developments, that has basically affected the sentiment for telcos as a whole. I think investors are still, very concerned about the losses coming in from equity accounting of DNB, which is anytime over the next 6 months. I think the telcos are basically guiding that it will probably be booked by the fourth quarter of this year. We've previously estimated that the impact should be about 5 to 7% on a full year basis, but since it's fourth quarter sort of equity accounting, that impact should be fairly minimal, about 1 to 2% in terms of earnings. Post results, we've made some changes, very nominal changes for the MNOs, Maxis and CDB. These are mainly OPEX related. We've made no changes in terms of fixed line coverage. That's Time and as well as TM, Telecom Malaysia. We continue to like the fixed line space, given its resilient earnings and stronger attractive growth tailwinds. You can see that the contributions coming from data center side of things has picked up. TM has gotten the expansion in terms of 2 DCs, one in Johor, one in Sabajai, I think executing really well. I think the utilization is actually going up as we speak. On the MNO side of things, I think if you do actually want that exposure, I think our top or preferred pick at this point is CelcomDigi. We like that synergy story that's coming back for them. I think this year will be that integration sort of concerns will probably recede over the next couple of months, and they're right. They're going through their billing platform upgrade, and by first quarter of 27, you should see them coming back into the picture in terms of taking market share away from their other rivals. So we're seeing a quite strong earnings growth for CelcomDigi in FY27. To be precise, it's about close to 20%. This year we'll see a bit of flattish earnings. That's really coming from some of the back-ended synergies, which will probably materialize in 27 and 28. They've also guided for the first time cost savings target about 450 million. First quarter, that number is just 40 million. So I think I do expect some ramp up in terms of cost savings into the second half of this year. So overall, no change in terms of the headline sector view. It's still a neutral, but our preferred picks are Telecom Malaysia and CelcomDigi for mobile. Okay, that's all from me for today. We'll see you again on Thursday. Thank you.